Hello, everyone, and a very warm welcome. I'm Myron Jobson, and I'm delighted to host our first Investment Insights webinar of this new-ish year. It's already proven to be an eventful start to 2026, and investors are understandably looking for clarity. And I'm delighted today to be joined by John Wyn Evans, our head of market analysis, who will guide us through the forces shaping markets right now and what they can mean for portfolios as the year unfolds. But let's start by briefly looking back. So 2025 was a strong year for global investments, with most major asset classes delivering positive returns. Technology led the charge, especially AI-linked names, with Nvidia becoming the first company to reach a $5 trillion valuation. Precious metals also surged on the back of geopolitical uncertainty and interest rate cuts, while commodities and mining sectors delivered notably resilient performance. Investors spent much of the year navigating familiar headwinds, geopolitics, tariffs, inflation, while relearning the value of diversification as growth and value styles posted broadly similar global returns. So how has the market narrative evolved as we are now in 2026? So far, it feels like a case of new year, but familiar themes. Tariff concerns have re-emerged with intensity, with threats linked to the Greenland situation triggering renewed bouts of volatility. And of course, there is AI, which continues to dominate market discussions. Valuations are drawing increasing scrutiny, with some commentators drawing parallels to the dot-com era, driven by heavy infrastructure spending, ambitious profit expectations, and a growing concentration in mega cap tech names. So the question for investors now is, what do these trends mean for markets? What might they mean for your clients' portfolios? And are we starting to see the early signs of new themes emerging beneath the surface? These are exactly the topics John and I will unpack for us today. Our aim is to help cut through the noise, and there is plenty of it, and bring some clarity to what matters most to investors navigating the year ahead. We'll also have a Q&A session at the end. There's a Q&A tab on the right side of your screen where you can submit questions at any point, and we'll come back to those before the session wraps up. So there's plenty to explore. So without further ado, let's dive straight in. John, welcome. Thanks for joining me. And by all means, please take it away.
Morning, Myron, and hello everyone else. And it's good to be back on the circuit, as it were, doing these Investment Insight quarterlies. They undertook a little bit of a hiatus last year as we went through the full merger process, but here we are back up and running again. So to move forward, I'm just going to go to some screen sharing. And it'll just take me a moment to get the slides up and running. Okay, so here we are, as I say, looking into 2026. First of all, though, we'll have a quick look back at 2025. As Myron mentioned, it was a good year for investors, certainly. So from that point of view, there's a lot to sort of applaud, as it were. Although, interestingly, one thing I have noticed is that many people still seem to be quite unhappy about it. On the one hand, you could point to some of the extraordinary rises we saw in some of the technology-related stocks, especially in the US, and people saying, well, why couldn't I have had more of that? And on the other hand, there are people who seem to be very worried as well that having had a good year of creating wealth last year, they're going to lose it all again, and some sort of crisis is going to emerge. And it just seems to be a sort of persistent condition, really, of these days and the times we're in, that markets seem to be rising and climbing the famous wall of worry, as it were. We're going to talk about AI as well, and what the risks and rewards potentially are around that. Moving to broader market conditions, obviously. covering some of the geopolitical stuff that's happening at the moment, and then look at some longer term stuff and how we think about markets as well. So, as they say, with no further ado, 2025. One of the really interesting things about 2025 was that it was one of those rare years when all the major asset classes went up. So equities, bonds, commodities, and credits all did well in the same year. And it's, as you can see from this chart here, there are not many years when that happens. And usually it's in a year where you're getting a bounce back from something dreadful that happened the previous year. But obviously 2023 and 2024 were good years for investors as well. So, putting all that together, you can see that the sort of accumulated gains of all of those different asset classes, the only year that's been better in the last 20 was the year following the financial crisis, when obviously things have been absolutely dreadful in 2008. So it was a marquee year from that point of view. Certainly, you can look at the reasons why. Global growth continued pretty strongly. Obviously, with the technology surge and AI investment was a part of the theme of that as well. Inflation coming back under control slowly but surely, and central banks around the world cutting interest rates as well and providing liquidity. So the various sort of elements of that, certainly, and some of them are going to dissipate a little bit this year, but certainly there's no signs that we can see that they're going to reverse dramatically either. If we look at the sorts of performance we saw within indices, it's quite different depending on where you look. So, for example, in the United States, it was the technology sectors which sort of drove the market higher, really. So communication services, which is dominated by Alphabet and Meta, was the best performing sector there. And IT generally was the second best performing sector. But even industrials was kind of caught up in the whole AI theme in terms of providing the picks and shovels and the infrastructure to building data centers, for example. So it was an extremely sort of growth-led year in the United States. But if I look at the UK market, for example, last year, which had one of its best performances in many, many years, it was financials that led the way in the UK and seemed more as a value sector, really. And healthcare also did exceptionally well, AstraZeneca and Glaxo having very good years. Materials was the next one down. That very much related to the rise in commodity prices and especially precious metals during the year. But certainly you can see how, especially the banks of the UK, have really kind of regained their status as investor favourites after a long period in the sin bin after the financial crisis. And even now, they don't look riotously expensive, it's fair to say. What I think I also we like about the UK market as well is kind of the greater breadth of performance. I mean, even though, yes, financials, led the way, but if you look at the sort of top 10 contributors to the FTSE 100 index last year, a lot of them came from very different industries. So the biggest contributor was HSBC from the banking sector. Then it was AstraZeneca, obviously in pharmaceuticals, followed by Rolls-Royce in the industrials, then BAT, the tobacco company, Shell, the oil company, Rio Tinto, the mining company, and then Prudential, the insurance company. So the one thing that the UK does offer actually is a slightly kind of more diverse profile in terms of its bigger companies and the contribution to the returns. However, as we left 2025, Deutsche Bank in its annual survey its monthly survey of clients in December was asking, what do you think pose the greatest risks to market stability in 2026? And by far the most popular answer, and possibly now slightly surprising given what's so far happened this year in terms of the geopolitical stuff, was tech valuations plunge and the AI enthusiasm wanes. And so with that in mind, I thought I'd sort of kick off this talk by talking sort of, generally about our thoughts about artificial intelligence and, what it means for markets and in terms of adoption and in terms of monetization of all the spending that's gone on as well. And, the good news is, we can see the risks, but we don't necessarily think that things are going to fall apart imminently. So yeah, I just took a few headlines from newspapers at the start of the year. You can see a bit of a theme building here, how the bubble bursts. 5 things you need to know to shield your finances from a crash. Fears over AI bubble stir warnings from history. It's scaremongering of the first order, should we say? And in some ways, yes, sensible journalism, because people need to be aware of what the threats are. But as I've made the point quite often in writing over the last year or so, newspapers have to sell, or in this case, websites or whatever as well. They have to attract customers and eyeballs, and the best way to do that is usually to put out a good scare story. It's bad news and scary news that actually draws the punters in rather than good news normally. And certainly, we cannot deny that AI has been the fastest adopted technology in history. This is the percentage sort of adoption in US households of various technologies, going from radio and electricity in the past up through smartphones and cell phones into artificial intelligence. And this line on the left here is obviously picking up much quicker in terms of the penetration than any of the others. I would say, though, that in many respects, you might expect that, because it's almost free. So, historically, if you wanted to pick up any of these other technologies here, you had to buy a radio, for example. You'd have to buy a smartphone. You had to buy a computer to get connected to the internet, whereas we've got all of those things now, and all you have to do is click a button, download an app, and ChatGPT or whatever your LLM of choice is available to you. So certainly, the way the world is today, it's very easy in many respects to get very, very fast adoption and penetration of new technologies. And I think that alone, should remind us that as new technologies come through and as new kind of ways of using AI are dreamt up over the next few years, they could penetrate very, very quickly, because we'll all have very easy access to them. The next slide shows the huge growth in hyperscaler capex. So the hyperscalers, broadly defined as Amazon, Microsoft, Google, Meta, and Oracle. These are the big builders of data centers, mainly in the United States. And you can see from here, this is when end of 2022, when ChatGPT was launched to the public. And since then, all you've seen is these lines starting to pick up as there's more and more spending being spent on building these data centers. So for 2025, the number is going to be about $400 billion. When you consider that was about $150 billion in the pre-ChatGPT world, that's already a big rise. But we're going up to 500 billion in the current year, and close to 600 billion as we go through 2027 and 2028. Now, obviously, the year-on-year growth rates are not going to be as large, but obviously, in terms of the actual size of the numbers, they keep on going up. And this means that your sort of accumulated capex is running into the trillions now, and obviously people are asking questions as to, well, who's actually going to be paying for this, and will they make returns on it? I think it's too early, to judge either way exactly which way this is going to go, but certainly I think it's one of the big questions for 2026. The other point about all of this, though, is just because they're big numbers, are they crazy numbers? And what this chart shows, first of all, on the top panel, is US tech investment as a percent of GDP. And you can see it's been on a rising trend from around about 3% of GDP in 1980 up to 7% of GDP now. So what this is showing you is that tech investment has become a much more important part of the US economy as the economy has evolved, and as we have all become, more, as technology has become more embedded in our daily lives. However, you can see that in the run up there to 1999, 2000, and the tech boom and bust, it got way, way ahead of trend, and then had to kind of mean revert after that. We had also a bit of a flip up here. This was kind of the reaction to pandemic and all the spending that went on around then. And then we came back to the trend line. And yes, we've certainly gone a little bit ahead of it now, but not as much as we did in 2021, and certainly nothing like what we did in 2000. And also, if we look at it in terms of the private investment in the US economy as a whole, and it really is the US economy which is the kind of epicenter of all this spending, you can see that we're kind of running along a sort of average level here overall, because actually, investment hasn't been very great in other parts of the economy, particularly if you think about things like real estate, which is still going through a bit of a bad patch at this particular point. So there aren't excesses running through the whole US economy now, which is quite good as well. And also, I think there's a feeling that many companies put investment and capital expenditure on hold through quite a lot of 2025 because of uncertainty about policy and tariffs. Now, some of that, uncertainty is still around, certainly, but with some of the things that were passed through in the One Big Beautiful Bill Act last year, which encourages more investment, and also the fact that you cannot put off investment forever, we would expect some of that investment to start picking up this year too. So from that point of view as well, there's still good tailwinds, I think, to the US economy. In terms of AI itself, then, where is this being picked up? You can see at the beginning of last year, this is when you really got the big ramp up in subscriptions to large language models and AI models and various platforms and tools. Unsurprisingly, it's the technology sector which is leading the way here. I think it's well versed, how important it is in terms of coding, especially, and things like that. But as we move down, finance is the next sector which is taking advantage of it, then down to manufacturing, and then slowly but surely you drop to sectors where it's actually quite difficult perhaps to get AI involved, because a lot of it is about physical humans and contact and everything, and things like accommodation and food services. So this is the direction of travel, should we say, in terms of where you might expect to see the impacts coming of artificial intelligence or generative AI. But then you look at how many companies within the S&P 500 were mentioning quantifiable benefits from AI adoption, and this was the last kind of data we had, which is through to the end of the third quarter of 2025. We'll see more of it now as we go through this current results season. And again, you can see technology, ahead, but it's below 40% as opposed to 75%, of companies actually taking, actually adopting AI, but they're not seeing the benefits of it. And we had about 50% in financials and only 16 seeing the benefits, and plenty more down here not really seeing any benefits at all. And this is kind of where the bears come out to play and say, well, obviously it's not going to work, and they're spending far too much money on it, and no one's actually can make it work and do anything for them. And I think that it's a classic case of the hype cycle of technology, where everyone gets really excited about it at first, then they get disillusioned with the fact it's not happening as fast as they hoped or expected or was priced into certain assets. And then actually the reality comes through and it's really sustainable, and that's where you get the very, very strong growth. And certainly, I think, again, one of the things we'll be looking for as we go through this year is those companies that are able to say that they have used AI solutions to improve their productivity. And I think one thing that certainly happened in 2025 was a lot of people just effectively used generic large language models, and they try to sort of shoehorn those into their own businesses. And actually what's becoming clear is that you really need to sort of design almost a custom built AI tools for your own business. And when you do that, you'll suddenly find the benefits coming through. So it takes a bit of time, maybe a little bit more investment to do that, maybe a little bit more help from somebody within the technology sector to do that as well. And one of the examples I've written about recently in my weekly digest was a company called C.H. Robinson. It's a US logistics company. Their share price was up almost 60% last year, but it had a big jump on the back of its third quarter earnings when it said we are seeing the benefits benefits coming through in terms of being able to put out quotes and billing and the way we handle logistics and inventory and stuff like that. So, I think it is happening. It's coming from a very low and slow base, but we may well be positively surprised by companies actually saying they're getting the quantifiable benefits coming through as this year progresses. I think the other thing that AI has to address is the social issues. It's plenty of scare stories around about graduates coming out of college, university, secondary education generally, and not being able to find work because the sort of grunty tasks that graduates are taken on to do can now be done by AI, and I think there is definitely some truth in that. But if you look at this chart, this just shows the potential flexibility, I suppose, of an economy. So back in the early 1800s, nearly 3/4 of people working in the US were involved in some shape or form in agriculture, and now that's about 2 or 3%, and yet it produces a hell of a lot more than it ever used to, and feeds an awful lot more people. And you can see, as agriculture became a much less important part of the economy, services and manufacturing picked up. But you can also see, again, how manufacturing itself since the 1960s as a share of employment has fallen, and services has just become a bigger and bigger part of the world. Now, obviously, there are people, particularly within the US government, who feel that this is detrimental to the US economy, and they're trying to bring more of that manufacturing back home. So we may well see that black line picking up at some point in the future. But then again, a lot of the new manufacturing might also be done by robots and AI assisted tools, as it were, as well. So we'll just have to wait and see how that goes. But I think the message from this is that economies are adaptable and flexible, certainly. And yes, there might be some sort of rocky bits along the way, but also, one would feel if the employment market in the US weakened because of that, then that would encourage the Federal Reserve to cut interest rates somewhat faster as well. So just wrapping that up, obviously there's only so much depth we can go into here, and we have my research analyst colleagues who are looking at very forensically at the individual companies involved and trying to pick out the themes and the winners and losers within that. But there's no doubt that the generative AI theme continues to dominate markets and sentiment. But I think what is interesting over the last couple of months or so is that it's maybe a little bit less so, because we've seen returns in the market broadening and some of the leadership in the market broadening out as well. So if you look at since the end of October, for example, the overall market in the US has outperformed the Magnificent Seven. In fact, the other 493 have outperformed them as well. The equal weighted S&P 500 index has outperformed the market cap weighted one, and global equities outside the US have outperformed the US as well. And yet, this has still been a positive period for portfolio returns. So definitely some signs there. And I think they're healthy signs that we're not entirely dependent upon this one smaller group of companies for the market's gains. In terms of AI, generally, I've always said we've never bet against it. I think that would have been a foolish thing to do. And, we said that in advance, and it's certainly true in retrospect. But it's always been difficult, I think, to be too overweight in the theme, just because of how much of your portfolio exposure you would end up having there. So obviously, when you're benchmarked against indices, this makes life somewhat difficult. But even so, you can still do pretty well, without being overweight the AI theme. And also what we're seeing, particularly last year, you can see how at various points different companies were deemed to be the leader in this area. So early on in the year, Google under Alphabet was deemed to be a loser in the AI world because its advertising-led business was going to be badly disrupted, and by the end of the year it was the out-and-out winner, but partially because of the success of its Gemini 3 large language model, for example, but also other deals that it made along the way. So the sentiment of the market can change pretty quickly. But as I've made the point, investors are increasingly demanding payback on the capital expenditure that's been made, and I think this is going to be a crucial year to show me the money, as it were. And then but we also expect more companies will begin to benefit from implementing application-specific generative AI tools as well, and that's just going to take a little bit of time. One final, slightly more light-hearted version here. The French mathematician and physicist and sometime philosopher Blaise Pascal, he had his wager. His wager was about God. He basically said, well, just in case God exists, as it were, you should probably live a decent life and possibly believe in him as well on that basis, so that when you get to the other side, as it were, you go to the pearly gates, not down below. And what this one is saying is, well, if the robots take over the world, then maybe we should all just be nice to ChatGPT and say please and thank you every time we use it. Okay, broader market considerations. One of the key things I think at the moment, which people talk about, is valuation. They talk about bubble valuations. They talk about the extreme valuations, particularly of the S&P 500 in the United States. And there is no doubt about the fact that on a forward PE of around about 22 times, it is right up there at the sort of high 90s percentile of historical valuations. But that's not a sufficient condition to say that it's going to collapse in a heap either. And also then, if you kind of look further down, so just to show, we got the US on the left-hand side here. US X, the big tech companies, slightly less, on about 20 times earnings, because the US is such a big chunk, about 2/3 of the All Countries World Index. So that leaves the All Countries World Index on about 19 times. And then you sort of go down to the more cheap markets, and particularly the UK still on less than 13 times earnings, emerging markets around about 13 times earnings, Europe on sort of 14.5 times earnings. So there is there's some value in the world, and I think that's partially what's been recognized in some of that rotation we've seen into other markets. But even so, I've been saying for a while, I do believe that the PE alone is a pretty blunt instrument, because it doesn't tell you anything about the underlying growth rate. It doesn't tell you anything about the returns that the companies are generating. And one slide I've used quite often in the past is this one, which I've taken from the most recent piece of Goldman Sachs research, which basically just shows the trade-off between the return on equity that companies make in various sectors relative to the price to book multiple. So effectively, the higher your return on equity, the higher you will trade on a price to book basis. And effectively, the P itself is just a kind of residual, really, of all of that. And you can see there's a very clear kind of line of best fit that runs up through this. The companies that have low returns on equity, because they're highly capital intensive, tend to have lower price to book multiples, and those with higher ones have higher price to book multiples. There's a few that fall off either side. Consumer discretionary in particular is quite distorted by the fact that Tesla and Amazon are the two biggest companies in that, and especially Tesla is very expensive if these sorts of grounds, because a lot of things are built in for the hope of the future in terms of robotics and AI and all that sort of stuff. And the ones that are looking kind of a little low on the line at the moment are healthcare and consumer staples. So we're hunting around potentially, I think, particularly in healthcare, where we think there's some good longer term value. But there's nothing in this that suggests that IT is egregiously overvalued, because you don't have that huge, or at least not until now, you haven't had that huge amount of capital required in the industry. A lot of it's based on intellectual property, and so the returns and the margins and the incremental margins are very, very high when you're in a growing phase. Now, obviously, if all this expenditure on data centers turns out to lower the ROE, then all other things equal, you would expect the price to book multiple to come down a little bit. And I think that's where the tension, as it were, in viewing this sector lies right now. The other point is just the great profitability of US companies. Back in the 1990s, we came from a base of 4 or 5% profit margins for US companies. But again, as the composition of the index and the economy has evolved and particularly become more led by technology and technology companies, margins have gone up. But it's not just in technology. It's really right through a lot of the market and a lot of the economy in the US. Companies have just become more efficient over this period, and to some degree using technology to achieve that as well. Yes, they've also been helped by the fact that interest rates have been on a falling trend through this period. So interest payments are lower, and also corporation taxes have gone down as well. And it may well be, it's almost impossible to get the same sort of tailwinds that we've seen over that period replicating themselves. But for now, at least, the sort of consensus of analysts' opinions does expect margins to keep on rising over the next couple of years. So again, that's one of those things we'll keep an eye on. If they start to come under pressure for any reason, that would certainly be a cause for concern. And then when we look at actual earnings, so when we get to the the E part of the PE, again, as we go into 2026, there is an expectation of acceleration of earnings growth for the S&P 500. We're looking for annual growth potentially of around about 15% in 2026. We're just going right into the current reporting season for Q4 2025, and you can see what these lines represent here. This was the expectation going into the last few quarters, and the blue dots were the outcomes. So they've overachieved in all of those, and again, we'll see how that turns out this time around. But there's good growth coming through effectively, and I think in an environment where you've got earnings continue to grow, it's very hard to see any reasons really why the market should go backwards. It might derate a little bit, might go up less than the earnings go up, but you should still make positive returns. The growth rate's not quite as punchy in other parts of the world. They're around about the same in emerging markets. They're more like kind of mid to high single digits in the UK and Europe. But as I say, you're coming from a slightly cheaper background in those particular markets. In terms of bubbles, I mean, again, want to sort of lay to rest some of the scare stories, I suppose, around this. Various commentators have been talking about it. Michael Berry, who's the hedge fund manager who was made famous in The Big Short and made a huge amount of money from the financial crisis as well, but by betting against the housing and property industries in the US. He's been putting various things around, showing that various bubbles in the past, the railways in Britain in the 1840s, the US market in the 1920s, Japan in the 1980s, then NASDAQ. These are all things that came up and popped again on the other side. And, he's saying it's going to happen to the Mag 7 in the 2020s. Well, it may. But one thing he also notes is that you start seeing a tightening of financial conditions is kind of necessary condition really for the bubble bursting, and even then the bubble carries on going for a while even after they start to tighten. Now, if you look at financial conditions in the US at the moment, they remain very loose. So this is a Goldman Sachs US Financial Conditions Index since 2020. Now, you saw the further the line up is the tighter the financial conditions. This is made up effectively of the US bond yield, US credit spreads, the dollar index, and the S&P 500 or equities generally themselves. So it's kind of slightly self-feeding and pro-cyclical, but basically the lower the line, the easier financial conditions are, the higher the line, the tighter financial conditions are. And you can see we've been on this falling trend of easing financial conditions really since the end of 2022, and unsurprisingly, in many respects, that's why markets have generally tended to go up. Now, there have been a few little wobbles along the way. There's a little bit of a wobble in the bond market towards the end of 2023. There was the tariff situation in Liberation Day in April last year. but those turned out to be blips, and the trend has been down. And financial conditions now are as easy as any time they've been since the first half of 2022. But it's also worth pointing out that they're still a hell of a lot tighter than they were in that hugely speculative period we saw in 2021, which was memes and SPACs and crypto and everything you can name of going a bit bonkers, where we were much more worried at that point about some of the stuff that was going on. But in reality now, there's nothing here that tells me that there's nothing drastic to worry about. And if we look at those particular components, there is some expectation that dollar will be a little bit weaker this year. We're not calling for a big fall in it or anything like that. So that would ease US financial conditions, certainly. The Fed is expected to continue cutting interest rates in the US. Credit spreads are historically very tight. I'm not sure how really much more they can come in. And then there's the bond market, and we'll talk a little bit about where bond yields are in a moment, but they're around about fair value. But obviously there's a risk that, as we've seen in the last few days, when we saw a bit of a sell-off at the long end of the bond market, associated with concerns, well, partially to do with the Greenland business and the tariffs, but also to do with a bit of a sell-off in the Japanese bond market as well. That's, again, something that we've got to keep an eye on as a potential risk factor. Another one would be a big rise in inflation expectations. And again, what we're not seeing, even with all the talk about Fed losing its independence and this sort of stuff, there's no signs particularly that the market is believing that the Fed has lost control of inflation at this particular point. So this is US inflation expectations as taken from the break-evens. So it's the sort of difference between the TIPS price and the conventional bonds. And what the market is saying, that on average over the next 10 years, inflation is going to be about 2.35%. Now the target obviously is 2. We think the target is not really that worried about it as long as it's somewhere down near the 2 level, but it's sort of been stuck in this channel really now for the last 3 or 4 years, and not moving away from it drastically. Obviously during the kind of big inflationary period in 2022, that was when we got a bit out of line. But I think what I would also point out, and I've put the white line over here at 2%, is that in the sort of 5 years running up to the pandemic and then the Ukraine war, inflation expectations very rarely went over 2%, but now they don't seem to be able to go under 2%. And there definitely seems to be some kind of regime change in terms of inflation expectations here, driven by the changes in the world. A lot of it's political, the shift towards populism, more fiscal expenditure, but also the move away from globalization. And I think climate change and the energy transition and everything are all part and parcel of this as well. So we do believe that inflation will remain structurally higher than it was in the pre-COVID world, but not necessarily, talking scare stories about 1970s style inflation or anything like that. Here's another one, just in terms of playing the odds, as it were. So if there is no recession in the United States, based on historical data, there's only a 4% probability of a decline in equities of at least 10%, and an 87% probability of making positive returns. Well, currently we do not see a recession on the cards in the US. You can see what the market's telling you as well, as you can look at things like Poly Market these days, and the betting odds, that's going around about 21% probability. So that being the case, again, the probabilities are on one's side at this point. Now I mentioned bond yields. So what I've been, using this as a kind of template for a while, as a sort of anchor for where I think the right level of 10-year bond yields should be. It's basically nominal GDP. And if I look at a range for trend real GDP in the US, UK, and Europe, and then I add on what I think kind of a range for inflation should be, and the UK, I always give a bit of an inflation premium to the UK because we do seem to have a more structural inflation problem here than in other regions. You come up with your nominal GDP range, you take the middle of that, and that gives you the implied yield. And lo and behold, the US 10-year yield is almost exactly where it's supposed to be on that basis at the moment. UK 10 years a little bit high, and the EU yield is a little bit low, and that's, as I said, the average of France and Germany. So, but they're relatively close, and I really don't see great value necessarily in the bond markets at the moment. At least you've got a bit of yield to play with right now, and we've certainly, because we have longer term concerns about sort of fiscal situation, we are sort of playing at the shorter end of the maturity curve in terms of where we want to be positioned in our bonds right now. Just looking quickly at the UK, I mean, it's limping, isn't it? I mean, growth for 2025 looks as if it's going to be just over 1%. It's been running at virtually nothing for the last 3 months of last year. Interestingly, also, if you look at the non-government sort of GDP, as it were, it's pretty flat. So all the growth really is coming from government spending. And we need to get this part growing faster, maybe the Labour government getting out of the way and stopping making so many silly decisions might help on that particular front, but also hopefully a bit of tailwind from growth in the rest of the world as well can help there. But it's hard to see a great acceleration certainly in the UK economy at this particular point. However, what are markets saying about the UK? I keep an eye on the pound as my main barometer of people's views, and actually it's been really stable since Brexit here and the big devaluation we had of sterling post Brexit and the referendum. It's been stuck in this sort of range. In fact, if anything, it's actually slightly at the high end of the range now on its trade weighted basis. So no alarm signals there. However, let's watch out for example, the May elections, the local elections, and how they turn out. If there's a signs there that we could get leadership challenges in the Labour Party and it takes the party potentially more to the left, that's not a guarantee by any stretch of the imagination, but it might well happen. I would have thought that particularly international investors would be slightly concerned if that was the case. But for now, relative equilibrium here. Then we move on to the US. It's taken a while to get here. There's a big event going on in the United States on the 3rd of November this year, which is the midterm elections. These are the seats in the House of Representatives. Currently, you've got 213 Democrats and 218 Republicans and 4 vacant seats. And it doesn't take many to shift, does it? So the control moves to the Democrats, and indeed the betting is certainly suggesting it'll go that way. And Trump's approval ratings are pretty low at the moment, particularly against people who are not Republicans. And to that end, he has to start doing stuff to increase his popularity, and some of the, well, I wouldn't call it sensible stuff, but maybe not as disruptive stuff to the rest of the world has been things like putting out decrees that institutional buyers of residential housing are going to be banned in future, so that they don't sort of mop up all the supply and make housing more affordable. I'm not necessarily sure that would work, but anyway, he's trying it. He's trying to put a cap on credit card charges of only 10% interest, when obviously they're mainly up in the 20s. But again, that could well blow up, because it might mean that actual availability to credit would be withdrawn from an awful lot of the people who need it. It would also really kind of put a massive dent in the profitability of a lot of the financial sector as well. So, they all sound like great ideas when he dreams them up and tweets them in the middle of the night, but actually in practical terms, they tend not to be. But, when you're having trouble at home, the best thing to do is do something overseas. And already this year, we've had the detention of Nicolas Maduro in Venezuela. And ostensibly, what is this all about? Potentially, it's about oil reserves. Venezuela has the largest reserves of oil of any country in the world, although it's very heavy, sticky, horrible oil, and it's very expensive to get out and to refine. And also there are some questions about whether those reserves really exist or how many of them were made up by Hugo Chavez when he needed to raise some money in the bond markets in 2006. So, but certainly, there's an element here of Trump flexing his muscles, as it were, against a weaker country, but also potentially securing some extra oil supply and possibly more importantly, making sure that supply doesn't get through to China either. So that was the first kind of big shock of the year, as it were. And then the second one was obviously the recent shenanigans around about Greenland. I wrote this week in the Weekly Digest about the Don Roe doctrine. So this stems from the Monroe Doctrine of 1823, which was the US President James Monroe, who effectively said, the Americas are for the Americans, and anyone who interferes, he was talking about Europeans at the time, is not welcome here, will be seen as an enemy. And that's effectively, what the Don Roe Doctrine is, this idea that the whole of the Americas are under the American control, and then the rest of the world can be split up into spheres of influence, with China dominating the East and Russia and either or Europe fighting it out, hopefully not literally, over our slice of the world. But the other thing is the sort of the strategic importance of the location of Greenland as well. So we don't normally look at the world from above, as it were, but this view that comes down from, looking down at the North Pole shows Greenland here as the kind of buffer zone really between North America and Russia. And these rather disturbing lines that you can see across here are the potential paths of intercontinental ballistic missiles. It is, again, rather worrying that we should even be looking at a map like this and discussing it. But the idea is that the US wants to take control of this area so it can implement its Golden Dome of air defense strategy, and potentially stop Russia or China taking control of it, although they haven't shown not necessarily any signs of doing so. So that's kind of the background to it. We took the view earlier in the week that this was an escalation that would be de-escalated, and so far we've been proven right. But you never quite know what's going to happen next. But certainly when we played through all the scenarios that could happen, they seemed pretty negative for both sides. It was a sort of mutually assured destruction, as it were, from that point of view, both politically and economically, and from a defense point of view as well. So some kind of sense has prevailed here. And once again, I'm sure Donald Trump will be able to go home and want to go home and say he signed another one of his great deals. I did have a slide prepared before yesterday's climb down about what the Europe can potentially do in terms of fighting back. For now, that has been kind of withdrawn. But I would draw your attention to the last bullet point here, which is this Europe's unifying moment. There was an absolutely, I thought, electrifying speech by Mark Carney, the Prime Minister of Canada, at Davos, and basically just saying how the old world order has been fractured. And it may well be that this is the kind of the kick up the arse that Europe needs to, implement some of the recommendations of the Draghi report from last year, and to pick up in terms of, lower regulation and lower barriers between countries and more innovation, and all these sorts of things, which actually could mean a catch-up moment for Europe, although it'll obviously take a little time to come through. So in terms of portfolio considerations, as I said, global equity markets around all-time highs. Everyone seems to be scared or unhappy. We don't judge that markets are in a bubble, but they could actually get into one. And let's enjoy that if it happens before panicking about it. Reminder that it's bad news that sells, and social media amplifies the noise. So let's remain focused on long-term returns. We invest predominantly in high quality companies, on which I'll say something in a moment. We have to diversify portfolios to keep it, riding out any storms, and don't get too exposed to any single themes or factors. I know I'm coming towards the end now and time is pushing on, so I'm just going to go very quickly through a couple of slides here. One thing that's been really notable over the last year or so is the very, very poor performance of what can be described as quality stocks versus, well, less high quality stocks, I suppose. This is a chart just showing the underperformance of European quality stocks. And this is another one showing Goldman Sachs baskets of strong versus weak balance sheet companies. So as that line goes down, the companies with stronger balance sheets have actually been underperforming. It's all part of the cycle to some degree, and maybe some of these quality stocks got bid up a little bit too high, particularly in the aftermath of combination of the pandemic and then the big fallout in markets in 2022. And no doubt, if you're familiar with what's going on with people like Nick Train and Terry Smith at the moment, they're really, really struggling to generate returns. However, we have a bias towards higher quality companies. That hasn't actually hamstrung our performance in the last year, I'm glad to say. And we do show that over a long period of time, higher quality stocks, which is good management, good balance sheets, all these sorts of things do tend to outperform. And this kind of informs the way that we approach our single stock investments in particular. It doesn't mean we can't kind of have sort of tactical moves into other areas of the market from time to time. And then the final thing, just a reminder really, when markets are kind of falling, as they will do at some point in every year, this slide just shows the little green dots on here are the peak to trough falls of the S&P 500 I've used as the proxy here in any year. Every year it goes down at some point, and sometimes quite a lot, but in 3/4 of the year it ends up making positive returns. So again, the odds are generally on your side, but you're always going to get a dip somewhere along the way. And I always like to show this chart to people when the market's having one of its little wobbles. Okay, so from a conclusions point of view, said, geopolitics are more impactful than ever and very difficult to predict. But I think one thing we have noticed, markets tend to overreact to events in the short term. So, don't panic. Some equities are definitely more fully valued and vulnerable to correction, but this is part of the natural market cycle. We are seeing evidence of rotation into cheaper markets and sectors. I've mentioned the UK. We did think, the UK budget did offer an opportunity to reset expectations for the UK. It wasn't really taken. So let's see what happens at the next big event, which is the local elections. I've mentioned inflation. I think it's going to be, somewhat higher than it's been in the past and potentially more volatile. So that particularly informs our bond positioning. Invest towards quality and stick to your future investments. You've got to have a plan and stick to it. And I think the final point I'll make is on artificial intelligence. It is set to change the world, and I think possibly in ways we can't currently imagine. I was given an example recently of an old technology, which is electricity. When that was first introduced, the Ford Motor Company, the way it first did it was, put in electricity and put electric lights in, which allowed its workers to work, longer and during the dark. It was pretty low tech, but it worked. But the real benefits didn't come through till they kind of electrified the whole production process and suddenly started churning out Ford Model Ts faster than people could drive them out of the factory. And I think it's that sort of acceleration that will happen at some point in the future. One other thing I'll just say before we move into the Q&A, we are doing more kind of social stuff through LinkedIn, and I post my weekly digest on there as soon as it's published, and also other ad hoc comments along the way. So if you want any of that, please send me a connection request and we'll deal with that as soon as it comes through. So thank you very much for listening, and I will stop staring my screen, and hopefully some questions will have come through.
Yes, brilliant. Thank you very much, and John, lots to consider for the year ahead. Yeah, let's just go straight to a question. So the first question that caught my eye relates to debt, and the question is, how will increase in government, global government and corporate debt affect financial markets?
Yeah, well, first of all, on the corporate debt side, I wouldn't worry so much about that because corporates are actually in a pretty good shape at the moment. Now, maybe the bigger corporates are better than some of the smaller corporates, certainly. But what we've seen is a sort of deleveraging of the corporate sector over the last few years, and indeed of the household sector. So yes, the other side of that trade has been that governments have taken on more debts, and particularly, there was the financial crisis, and then we had COVID, and also there's now kind of, just generally politics are demanding, more expenditure. There are a couple of countries, I think, that are in the penalty box, which are the UK and France in particular. But the US is running a, 7+% budget deficit. Germany's now picking up and spending more money too, for example. And a lot of, big countries have 100% plus debt to GDP ratios. And we've been saying for quite a long time, there are only certain ways that you can get out of this, and productive growth would be the best. And, it would be fantastic if AI came through and created a fantastic productivity burst, and the economies were able to grow, and, faster than the debt, and we didn't need governments to spend so much money to keep the plate spinning, as it were. So I think that would be the perfect way out of it. You're never going to see a major Western country default on its debt and not actually pay the numbers, as it were. So any scare stories you hear about that are worth dismissing. Then it becomes, the idea about we're taking more taxation, which is actually what the UK is doing at the moment, but to some degree as well, that will slow down growth in the long term. And I always come back to the idea that you end up having to run inflation a little bit hotter, and whether or not that will require keeping interest rates down at some point in the future, I think that is the end game, some sort of financial repression. We're not there yet, but we've been talking about this for a long time as one potential outcome. But these things are sustainable for a hell of a lot longer, perhaps, than you might think they are. And look at Japan; it's had 240% or so gross debt to GDP for many, many years. Its net debt to GDP isn't quite as high as that, but it has seen its it's continued to sort of labour along, and it hasn't blown up, as it were. A lot of that is because the central bank has bought its debt as well, but the fallout from that, and I think if you want to take a template for other countries, is that the yen has been exceptionally weak. So as soon as you start really dealing with your debt in that way, then the currency usually is the safety valve. But if all countries have to go through the same process at some point in the future, then what other currency do you buy? And I think that's one of the reasons why gold has been doing well too. But the other things that tend to do well, equities actually do quite well in that background as well. So, we certainly stick with them as a core part of the portfolio.
And speaking of gold, John, we have a question on gold. So what is your opinion on gold? It has had a fantastic year last year. What's it telling us, and what are the prospects from here?
Yeah, well, I think gold's going up for various different reasons. You can really see it sort of dislocating away from its longer term relationship, particularly with real bond yields in 2022. And that was around the time of the invasion of Ukraine, and when the US basically put sanctions on Russia, and it weaponized the dollar effectively and dollar assets at that point. A lot of countries thought, wow, if this is what the US can do, maybe we shouldn't have so many US based paper assets, as it were. So you have seen central banks around the world, and particularly places like China and Turkey or whatever, buying a lot of gold as part of their reserves. So there's definitely been reserve growth as well. But again, this kind of devaluation of fiat currency sort of thesis as well, I think, is playing into that. And one way of thinking about it is it's not gold going up, it's everything else going down. You think of gold as a kind of valuation constant. Now, obviously, it's had a hell of a run, and I would be exceptionally surprised to see it do as well, this year as it did last year. But as we know, the thing with gold is it's a very difficult thing to value because it doesn't have a stream of earnings that comes with it, as it were, and it also costs something if you buy it and want to protect it. So to that extent, it's something that lives in the portfolio as a sort of balancing hedge against things getting worse. But putting a finger on exactly what value or dollar amount it should be is actually is actually quite hard. But maybe look at a chart of the yen, of the gold in yen, and that might give you a clue as to perhaps why you should own it in the long term if your country is too indebted.
Brilliant. And just one last question related to interest rates. It goes, where do you see UK interest rates this year?
Yeah, they're almost definitely coming down, which is the good news. The question is how far, and to that extent, you know, be careful what you wish for, because if we're going to see interest rates starting with a 2 in the UK, it probably means that the bottom's starting to fall out of the economy, and we don't really want that to happen. The neutral rate is probably somewhere around about 3. The market priced estimates currently suggest close to 2 more cuts this year, which would take us down close to 3.25%. We certainly have some of our economic advisors that we subscribe to who think the economy is going to be a bit weaker than that, and say more like 3%. I don't think anyone's forecasting it beginning with a 2 yet. The good news is that inflation, although yesterday's data was a little bit stronger than expected, but there were some funnies in that, particularly things like airfares. So it may well have been the timing of when they were taken, but because of some of the sort of year-on-year comparisons, and also because some of the things that the government has done actually in terms of some of the costs it's going to take out on energy, for example, means that inflation could well come down to the Bank of England's target maybe as early as April or May, and that might give the Bank of England a bit more scope to cut somewhat faster. But certainly the direction of travel is down, but it will probably be the short end of the market that comes down, and not necessarily, you won't see longer term bond yields coming down that fast. But that means, in this country we tend to use 2 to 5 year fixed rate mortgages and that sort of stuff, so that will certainly reduce the pressure there, especially for people who are refinancing 5-year mortgages that were taken out very, very cheaply as we go through this year.
Brilliant. I think we'll end it on that, John. Many thanks for your thoughtful insights. And yes, that is all we have time for today. Thank you all so much for joining us and for all your thoughtful questions. Also, I should mention that if you've asked a question that went unanswered, we'll endeavour to come back to you directly with an answer. But before we wrap up, I just want to flag that the full session will be available on demand and will be shared by email in the coming days, so please do keep a lookout for that. And also, we'll really appreciate your feedback, so if you could take a moment just to fill out the short form provided, that'd be really helpful. It helps us to shape future sessions and make them even more useful for you. And if you have any further questions, just please do get in touch with your Rathbones contact. So we really hope you're leaving today with a clearer view of what's moving markets and what that can mean for portfolios in the months ahead. Until next time, thanks for joining us and take care.
Thanks, everyone. Goodbye.